Blog Talk
Welcome
Radio.
to the Food Pathogen Outbreak Recall Response Group and its Blog Talk Radio interview for today, Thursday, September 8th, 2011. My name is Andy Marino, Vice President of Microbiological Systems Engineering at AME. Our topic today is the types of insurance to protect the interests of, hold on please, I think we have somebody here, and the types of insurance that are available for food producers to protect throughout the world, to protect them from potential liability issues relating to food pathogen outbreaks and recalls. This is a critical issue for many food producers nowadays, especially with E. coli, Salmonella, and Listeria outbreaks becoming more and more interesting to consumers worldwide and devastating to food producers. Today, our guest is Michael J. Lieberman from Capital Risk Concepts Limited out of White Plains, New York. And, Michael, I was wondering if I could have you introduce your company?
Sure. First of all, Andy, thanks for having me. I appreciate it. My company, Capital Risk, we are an insurance brokerage firm. We're based out of White Plains, New York. We've been specializing in the food industry for 35 years. We probably represent, I would say, hundreds of companies that are in the food business. We work with companies in multiple sectors of the food industry, from produce to seafood, meat, poultry, prepared foods. We're a full lines insurance broker, meaning we handle all types of insurance. We've designed a number of insurance products that really broaden the scope of coverage and are specific to the food industry. Outside of insurance policies, we have developed programs where insurers are willing to provide credits to go towards risk management protocols. One example is setting up it's a credit that we've developed that helps our clients to set up fully functioning product recall plans in light of the Food Safety Modernization Act. I've been with Capital Risk Concepts now for almost 9 years. I love working in this industry, in the food industry that is. I come across so many wonderful and interesting people in this industry, and quite frankly, I love food. I love to cook food, eat food. I just love this industry very much, and of course, I love eating healthy foods.
Well, Michael, thank you for that great introduction. You know, as we were chatting earlier, you just came back from a wonderful holiday in Greece, eating their wonderful food. What are the best ways for fruit and vegetable business managers to evaluate their potential needs for insurance, especially in light of their income-producing goals?
Sure. I will say that my trip to Greece was fantastic. I highly recommend it. I know there is a crisis going on, but putting that aside, it was still a very enjoyable vacation with a lot of fantastic food. But getting to your question, Andy, I would say the best way for a business to evaluate their potential needs for insuring their income-producing goods is to really consider the entire supply chain. You have to consider it from farm to fork. The supply chain really presents a variety of risks that are diverse and hard to control. The first step in the process is risk identification. And then each risk should really be quantified and a judgment made whether or not the company can financially accept that individual risk. Each risk should be looked at from both a frequency and a severity perspective, and a decision then needs to be made to either self-insure, partially insure, or fully insure that risk. In my opinion, when a risk is easily self-insured, there's really no need to waste any premium dollars on that exposure. You should really put that money towards other risks that could have more of a substantial impact on the bottom line.
Wonderful. You know, Michael, what you're outlining is really important. So that if our company, for example, were to choose to insure some of our supply chain risks, what kind of insurance is available?
Well, there's multiple types of insurance that are available. It's just a matter of piecing together the appropriate policies. There's no single product or even package of products that respond directly to fruit and vegetable supply chain risks, for instance. But there may be a number of individual policies that, when cobbled together, a company can use those policies to address nearly all the risks that one chooses to either partially or fully insure. This process of putting individual policies together is a bit like building a wall of protection. Each individual policy is like a brick within that wall.
That's a wonderful analogy, building a wall to protect a business. Some of these businesses have been in, food producing business, been in their family for generations. So yeah. How does a company protect their supply chain wall? Brick by brick.
Or how does a company build their wall? It really all depends on the unique needs of a business. There's no set protocol. The nature of the fruit and vegetable supply chain has really changed on a worldwide basis. Today, most fruit and vegetable businesses range from companies solely dedicated to importation of fruits and vegetables, while others are worldwide, multifaceted farmers, processors, importers, and exporters all in one. Also, a company needs to look at the shipping methods, packaging methods, and the specific product characteristics need to be part of that equation. To begin building the process, you really need to select a competent coverage designer, an insurance broker or agent with the expertise and the experience in dealing with your products as they move throughout the supply chain. It's important to choose an insurance specialist that really understands your industry. They need to know what questions to ask in order to get all the information that is needed to build an effective insurance product. The coverage designer examines the entire spectrum of needs and selects not only the policy forms, or the bricks in this analogy, but also the risk management practices to build that wall. The coverage designer or the agent broker works within a budget and tries to purchase the appropriate bricks at the best price. Usually the bricks need some or a lot of modification to meet the intended needs of the particular company. Does that make sense?
Yeah, I mean, when you're talking about these bricks, I think it would be a little helpful if you could outline what types of insurance policies would be important to build a supply chain wall of protection.
Sure, I can do that for you. We would need a lot more time to really go into a lot of detail. Quite frankly, I know most people can only devote a limited amount of time to insurance because it's not the most interesting topic, but we'll try to make it interesting for today. But I'll outline a few of the policies that are used to build this wall of protection. One policy is the marine cargo policy. When I say marine cargo insurance, a lot of people think just about ocean transport. That's not the case. We're talking about ocean transport, air transport, truck transit transport. This policy ensures all of a company's transportation and storage risks from the farm to your buyer in one comprehensive, seamless policy. Another policy that's one of the bricks in the wall is product contamination and product recall insurance. This ensures the value of your goods due to a contamination event, including your loss of gross profits. From an example of a loss of gross profit is a contamination event that leads to a company losing a major customer. So losing that account and the income that you would lose from losing that account due to a contamination event. It also covers the recall cost and the rehabilitation costs for not only the product, but also the brand name, the company name in the marketplace. There's a lot of PR efforts that go into that, and this policy can cover those. Then there's another policy or brick in the wall is product liability. This ensures liability for bodily injury and property damage due to your product or the sale of your product. There's also trade disruption insurance, yet another brick in the wall. This is relatively new. Coverage was specifically designed to protect businesses against disruptions to the supply chain, even when there isn't a physical loss to their own asset. Some of the typical causes are embargoes, confiscation, terrorism, strikes, political violence, blockage of waterways or closing of ports, natural perils such as hurricanes, which we've seen here on the East Coast, and other windstorm type events.
Michael,
another thing.
Michael, I think you and
yes,
I chatted a while back that you were really enveloped with this hurricane. Your clients were calling you all the time and asking for your advice. This insurance would be critical during that time, wouldn't it?
It would absolutely be critical at this time, or at times like these. A lot of my clients who are down on the Gulf Coast, for instance, they are well prepared for a hurricane. They have their plans in place. They have their generators ready to go. They've lived through these things, and they know what they need to have in place outside of insurance. But with the recent hurricane that swept up the East Coast, many of my clients, they really didn't know what to do. They didn't know what their insurance even did for them, let alone having some type of contingency plan in place, if the hurricane were to disrupt their business. So yes, this type of coverage would definitely come in handy, Andy.
Great, keep going. I'm sure there's more.
Sure.
Trade disruption. Go ahead.
Trade disruption we left off on. Then there's political risk coverage. This is really a subset, I would say, to the trade disruption insurance that we just discussed, and it's primarily oriented to a limited part of the entire trade disruption exposure. Some of the typical political risks are revolution or insurrection, civil unrest, terrorism, war, governmental confiscation. Another piece, just to get the ball moving on this, is credit or accounts receivable insurance, and this is really a policy to cover the payment risk. Credit insurance usually covers a portfolio of a company's buyers, customers, and it pays an agreed percentage of that invoice or that receivable that remains unpaid as a result of default or insolvency or bankruptcy. Another thing that a company needs to consider in this wall of protection is the indemnity agreements that they enter into. While these agreements are not technically an insurance policy, it really needs to be considered as a critical brick in your wall of protection. These agreements deal with a number of policies that a customer requires the vendor to maintain. I would have to say that this is probably one of the most misunderstood and most uninsured supply chain risks among food industry businesses. The biggest misconception is that insurance covers all of the risks that are stipulated within these agreements, and in short, insurance doesn't cover all of the risks. The uninsured loss potential is enormous, and this issue really needs to be looked at very closely.
Well, Michael, I'm glad I have you on the call today. I know I have a lot of clients that are concerned about how an outbreak really impacts their business, and your particular expertise on insurance, particularly outside of the indemnity agreement, really would help us understand that. And what's the most misunderstood of all the things you just talked about?
Well, definitely outside of the indemnity agreement issue, I would say the most misunderstood brick is the product contamination, product recall insurance. No doubt about it, it's been the most misunderstood.
Well, that's outstanding. Our group is called the Product Recall and Response Group and Contamination Group. That's what we're interested in. Could you tell us a little bit more why it's so misunderstood and why it can help my clients?
Sure. Well, first of all, many businesses or many of my clients and prospective clients that I speak to in the food industry, they're under a belief that if they have product liability, which is one of the bricks that we discussed, if they have product liability insurance, that they are covered for a contamination recall event, and this is not the case. Certain aspects of a contamination event can be covered by a liability policy. For example, if a company sells contaminated goods and the consumption of those goods leads to people getting sick, the insured is on the hook for the medical expenses and other damages suffered by the customer. This is a situation where products liability coverage would definitely kick in, but it will not kick in for a company's first-party losses, such as the replacement value of the contaminated product, or the company's loss of gross profits, or the consequential loss of gross profits to the insured's customers. In some cases, there may be access to a small bucket of money under a liability policy, but that's only for pure recall expenses, such as the transportation to get contaminated goods back into your possession. But this limit that is offered is usually a very small amount, such as $25,000, and in most cases, it would probably never be triggered based on the wording of the liability policy.
Wow, that's really helpful information, because I have a client that suffered a $10 million challenge from one of their consumers, consumer product, the damage, and I think if you could help us understand on how my clients just can't rely on liability coverage just to cover their expenses on a contamination recall event. Let's focus for a minute on standalone contamination recall policies. Why is this policy so controversial and misunderstood?
Well, as it stands now, Andy, there's probably 10 to 12 contamination recall policy forms in the marketplace. So what this has done, it's created a very competitive atmosphere in the insurance marketplace, which isn't necessarily a bad thing for potential insureds. However, these policies are very, very complex, and all of these forms have drastic differences. No one form is the same as another form. I've noticed that many insureds will allow price to drive their decision. Without proper analysis of the coverage form, making the decision to buy based on the lowest price can lead to a poor use of premium dollars and potentially devastating uninsured losses.
Wow. Can you give me some specific examples? Because I really don't understand all the policies you just mentioned, other than there are policies out there.
Right. Well, the first thing that I like to evaluate with my clients or potential clients is what I call the coverage trigger. The coverage trigger being the events or the series of events that must take place in order to produce a covered event under that particular policy. In some policies, contamination recall policies, I have seen coverage trigger wording that states that coverage will trigger if the insured's product may be contaminated and consumption of that product may lead to bodily injury. Now, on the other hand, I've seen policies that in order for coverage to trigger, the insured's product must be contaminated and consumption of that product must lead to bodily injury. There is a huge difference between the words may and must. That is one prime example of a difference that I've seen between different policy forms out there in the marketplace.
Very interesting, Michael. So it seems as though some policies will cover you in the event of a possible contamination event, while others will only cover you in the event of an actual event. That's right. Can you give me another example of the difference between policy forms?
Sure. When evaluating the overall impact of a contamination recall event, I look at the potential physical loss of the product. Now, when you're doing this, when you're evaluating the potential physical loss of product, you have to look at not only those products that are sold to customers, but also the products that could still be in the possession of the insured, sitting in their warehouse or sitting in a public warehouse somewhere across the United States or around the world. In many cases, the value of the product that's still in the possession of the insured can easily amount to more than the product that is out there already sold to their customers. However, there are some policies that will only reimburse the insured for products that have been sold, not products that are still in the possession of the insured. As you can see, this can easily create a large uninsured loss, and quite frankly, the expectations of my clients, I know that they would expect to be paid for all of the contaminated goods. So really, these types of policy forms, if you don't know the policy language, your expectations are not going to be met at the time of loss, and you can be in a very, very sticky situation. So what I'm saying is there is coverage available out there in the marketplace for both sold and unsold goods.
Well, Michael, can I break in here for just a second? I think that's a critical point, because a lot of my clients will send out their products in lots, and one item will be contaminated, and then they'll have lots and lots of their products unsold. And they are under this misconception. Is that what you're saying?
That's exactly what I'm saying, Andy. And really, when a company thinks about a recall, they're always thinking about, I have to recover all this product from the stream of commerce. I have to, recover all this product from my customers. My customers are going to be angry. But at the same time, you're sitting on product that's still in your possession that could, if you lose that product, it can financially be devastating to a company. So you have to look at the entire risk, and you have to make sure that you're covered for the entire risk.
Fascinating. So you and I had chatted about coverage triggers. What are those?
Well, coverage triggers, as an example, and it really goes by policy forms, but a coverage trigger would be any situation that could possibly lead to a Class 1 recall. So any situation where there's the potential for bodily injury. That's an example of a coverage trigger. But once again, some policies stipulate that either the insured must prove that the product is actually contaminated, otherwise they don't have coverage, while some policies stipulate that the product may be contaminated. As you know, Andy, there's been some recall scenarios in the food industry over the past couple of years where companies have suffered even when their product has not necessarily been contaminated, but they've been roped into a recall scenario where they're losing sales because there's press out there that their product may be contaminated. So that's an example of a coverage trigger.
So you had mentioned before that there are differences in other types of areas in your policies, like what did you say, limits and how they're applied and other things?
Sure, yeah. I mean, beyond the issues of coverage triggers and what types of goods are covered, like we spoke about before, how sometimes some policies will only cover sold goods and some policies will cover sold and unsold goods. There's many other differences between policy forms, such as limits, like you said, limits and how they're applied. There's also differences in the warranties and the conditions that must be met by the insured in order for coverage to exist. There's limitations, policy limitations that are different one form to another. There are a number of exclusions that are different from one form to another. And also, even during the application process, there are differences from one insurer to another. For example, there are some insurance companies out there that will make you list your products, and you're only going to be covered for those products that are named on that list. So if I have a client who is selling apples and only apples, and they name that on the application, and then 6 months down the road, they decide to sell bananas, and they forget to mention that to the insurance company, there's no coverage for the bananas, while some insurers will make some room for error there. So that's an example of another difference.
Well, it certainly leads to the conclusion that my clients, the food producers, really need to keep in touch with their insurance broker and really keep an eye on their policies and read every comma and every period and every may and shalls. Hey, I wanted to cover one issue in the minutes remaining.
Sure.
You had chatted with me earlier about a $5,000 credit from their insurance premium for a mock recall exercise. Can you walk us through that real quick?
Sure. Like I said at the beginning of our conversation, even today on this phone call, we here at Capital Risk, we've developed a number of programs and policies that are exclusive to our clients in the food industry, and we've even gone outside of the insurance contract to even try to bring more value to our clients. And one thing we noticed that our clients were struggling with is to actually construct a well-designed, effective recall plan. a plan that really needs to be understood by everyone within an organization. So what we did, we went to some of our insurers that we use for product recall, product contamination insurance, and we asked them if they would be willing to give our clients not a premium reduction, but a premium credit to go towards the expenses of bringing in an outside consultant who is well-versed in creating recall plans to help our clients create a highly effective written recall plan. One may ask, why would an insurance company like this? Why would they get on this wagon? Why would they want to pay for this? Well, in the end, it really makes the risk a lot better. And our insurers, they recognize that if one of our clients had a recall event or contamination event, that if they had a highly functioning, well-oiled recall plan, that the potential impact of that recall would be a lot less. They would have our clients would understand what to say and what to do the moment they had a recalled product, and that could really help with minimizing the overall effects of that loss from a financial perspective. So we have an agreement with our insurers that if a client purchases a policy, that 10% of the premium, up to a maximum of $5,000, will go towards bringing in an outside consultant to help our clients in constructing these recall plans. And quite frankly, Andy, these recall plans, it's something that a company must have in place, especially with the Food Safety Modernization Act.
Wow, Michael, I really learned quite a bit, and in the last few remaining minutes, and we have about 2, by the way, I was wondering if you could just review CAP in your own words, Michael, the programs and the special offerings that Capital Risk Concepts and your experience offers for food producers, and kind of a going comment in this. Really, a lot of my clients are in a state of crisis looking at recalls and outbreaks.
Sure. Well, once again, I think the one thing that we really offer to our clients in the food industry, and I'll keep it focused, since we're on the topic, I'll keep it focused on the issue of product recall and product contamination. We have an understanding of what food companies are up against. We understand the food safety laws. It's not that we just understand insurance. We understand how insurance will or can and cannot respond to a certain event. So we can help our clients to insure for everything that's possibly insured against, and even in situations where insurance is not available, we can help our clients mitigate that loss. This is from years of expertise in the food industry. And in closing, I would say that yes, the food industry, many businesses out there in the food industry, they are in a state of crisis. But there are solutions out there. There are people out there who can help, such as yourself, Andy. And I have to say that do I think everyone is prepared for a recall event? Some companies are. Some companies have taken the right steps, but there's many out there that are not. And I'm not talking about having an insurance policy in place. I don't think insurance is necessary for every company. Many companies risks, understanding the risks, understanding the potential impacts, and they've made the decision to self-insure, and that's okay. But what
Michael, I hate to cut into you, but I do have to let you know that our time has expired. I appreciate and thank you for participating in this program today. I know our clients will really appreciate the counsel.
No problem.
Bye now.